Hello everyone, good evening. I'm bringing you a quick video surrounding the topic of call options. I'm going to go over some pricing, selection, and overview. I constantly see a lot of you guys getting burned by call options, and I feel like a lot of that has to do with buying weekly calls, especially in a stock like GameStop or AMC. You'll want to avoid weeklies at all costs because likely you're going to just throw your money right back to the hedge funds. Let's go ahead and take a look here. So call options are contracts. Each contract is valued at 100 shares per contract. Calls are a bet for the stock to increase in value, of course. A call is an option contract giving the owner the right, but not the obligation, to buy a specified amount of an underlying security at a specified price within a specified time. Now, call options are in the money when the stock price is above the strike price at expiration. If the stock price is below the strike price at expiration, then the call is considered out of the money and expires worthless, meaning you cannot exercise it, completely worthless. The call seller keeps any premium received for the option. Now, this is where money ends up getting transferred back to the hedge funds, because if you sell, you have the option to buy a call and you have the option to sell a call. When you buy a call, it's a debit, so you're paying. When you sell a call, it is a credit, so you get a credit up front that you will get to keep if in fact the call expires worthless. So buying a call is a debit, again, selling calls is a credit, and you can actually do both of these. It's a very well-known strategy called a debit spread. It's where you buy a call, let's say at a $20 strike price, and then you sell a call at a $40 strike price, and you save the difference between those two. So looking here, we're looking at the AMC option chain in Webull. The purple circle has all of our dates available to choose from. Highlighted right now is this current week, 4th of June. In the green, we have the in the money calls, in the money strike prices. And in the red, we have the out of the money strike prices. Now, the blue circle represents the bid side, which is the green number, and the ask side, which is the red number. Similar to how stock works, the only difference is you take the number you see, multiply it by 100, and that will be your price per contract. So when you're buying call options, and this is the important part that I think a lot of people overlook, my personal strategy, I look at 5 very important metrics. I look at delta, which is the amount an option price is expected to move based on a $1 change in the underlying stock. Delta is important because the higher the delta, the closer it is to 1, the more money you're going to make as the stock moves. Gamma is also a very important metric. I'm sure you've heard about it through gamma squeezes. Now, gamma is the rate of change in an option's delta per 1 point move in the underlying asset's price. So the higher a gamma is, the more your delta is going to move. So it's these two here are profit potential metrics. The higher the better for both of these. Implied volatility is a metric that captures the market's view of the likelihood of changes in a given security's price. So as we all saw in the last slide, the implied volatility for this week's calls are ridiculous considering we just ran a good amount last week and are continuing this week. I also like to look at theta. Now I feel like this is one of the most important Greek symbols to take a look at as far as options data, because it is the only one, if you're buying a call, that's working against you, and that is time decay. So the higher your theta is, or the lower actually, your theta is always going to be negative. And the lower that number gets, the faster and faster you're going to get time decay, which is going to hurt the speed at which you can profit. So it's not all about where the price is in options. If you buy a call option with a bad theta, and it's a weekly, for example, you're not, by the time the stock moves, if it doesn't move fast enough, it's not going to be worth it. So not only do you have to make an accurate prediction as far as where the price will be, but also you have to look at some metrics and make sure that it can get to that point fast enough. Otherwise, the theta gang will eat you up, and it'll hurt your profits big time. Volume and open interest. Now, volume refers to the number of contracts traded in a given period, and open interest denotes the number of contracts that are active or not settled. So we see a lot of this going on in the options chain that we've seen in the past few weeks, like what's circled right here in the yellow. That's going to be our open interest. I'm sorry, that's our volume. Open interest is actually blank. It looks like we have a lot of retail purchasing calls for this strike price listed right here. Now, to give you an example of pricing, so the purple circle represents the strike price that we're looking at. This is the AMC options chain for this week. The price of one contract is going to be $40, so it is a relatively expensive call. It does expire this week though, so keep that in mind. Now, again, volume is 60,215. Open interest is blank. Implied volatility is massive. Our delta is 0.10. Our gamma is 0.01. And our theta, now this is the important part, is negative 0.36. So that theta right there, given the implied volatility and the theta, it's very unlikely unless we see prices, above $60 by Friday for this thing to print. So just keep that in mind when you're trying to price options out. I wouldn't just look at the cheapest one, because you got to realize it's cheap for a reason. There is a way to shop and look for very good deals based on these metrics right here. Let's continue on. So as opposed to the call we just looked at, let's look at one now a little bit further out. This one is expiring in August of this year. It is also AMC. The call we have selected is $70. Now, of course, it is more expensive, but you have to look at your risk involved. Your theta's negative 0.12. You have a very nice delta, and you have a very nice gamma. You have some open interest and some volume. So you take the price the stock's at now, multiply it by 100, you're still getting a discount overall. So this right here is critical. If you're buying a call option with a theta, below, I'd say 0.20, and it's a weekly, especially on a short week like this, very unlikely it'll print unless we see just a complete moonshot from AMC. Because that's the whole idea behind Max Payne, is to purposefully make these calls and puts not print. So on both sides. Thank you guys for watching. I appreciate the time. Hopefully this answered a few of y'all's questions and cleared up some confusion surrounding options. So my personal advice, don't do weeklies, especially for AMC and GameStop. Get some a couple months out. You'll be very surprised with the results. Weeklies just end up burning you and give money back to the hedge funds. So y'all have a good one, guys.